Ever wondered what an income annuity is and how they work? Well, by the end of today's video, you're going to understand exactly that. My name is Ethan Miko, co-founder of Scenic Financial. Be sure to subscribe to my channel and hit that notification bell to be notified when I post new videos every week. So essentially, income annuities are designed to provide you with income for life. To get this benefit, you often have to buy a rider or an add-on to it. And this type of annuity can be quite confusing. Okay, so on my screen here is an example of an income annuity. So this annuity policy is designed for one thing and one thing only, and that is to provide us with income for the rest of our lives. This is not the type of annuity that you can invest in for a short time or take large chunks of money out of it anytime you want to. It's really just designed for income only. So you see up here, the client put in $300,000, and you can see that issue under the contract value here. Now, when you have money in these type of policies, the cash you actually put in does get invested and will go up and down depending on how the markets perform. This particular one that I'm using is an indexed annuity. So again, indexed annuities don't lose money when the markets don't work out. So you can see that in this table here called credit interest rate. When we look at year 5, we got a 0 return. And we look over on the left-hand side, there was a return of -4 in that investment and -0.34 in this investment. So this type of annuity protects you from those kind of losses, which can help the cash value last longer in the annuity. And whenever we get a positive return, like in the first few years here, we're going to get interest credited, which will go into our account value. You see that the interest earned doesn't equal what's in the contract value. That's because we haven't accounted for fees yet. Anytime you have an income annuity, you're going to have a rider attached to it, which provides you with that lifetime income. And that rider is going to charge you a fee, and that fee is going to be taken out of your anniversary value or your cash value. If you use perhaps a variable annuity to provide your lifetime income, your fees are typically going to be much higher because you're going to have to pay some sort of administration fee to the insurance company itself on top of the rider fees. And also the underlying indexes that you're invested in will also have fees in those type of policies. So typically variable annuities tend to have higher fees than these index annuities. And those higher fees will eat away at the cash value much quicker than what you're seeing on the screen here. And that's why I'm showing this one here. It's just showing you the lower fee option to use. Okay, so now that that's out of the way, how does this actually work? Well, when you have an income annuity and you have that rider, you're going to get something called an income base. This income base is essentially a separate account. This is not your cash value, and that's what they're going to base your guaranteed for life income on. So you see in the first year they put in $300,000. They're going to get an income base of $300,000 here as well. Now each year you hold off collecting income, you're going to get a credit. And these credits are typically going to be guaranteed for a period of time. The particular one we're looking at today gives a credit of 9.5% for the first 10 years. So what that means is for up to 10 years, you can defer or not take income, and they're going to give you a guaranteed 9.5% credit to your income base. Again, this is your income base, not your cash value. Your cash value is over here, and it's going to go up and down depending on what the index or the market does. So it's one thing you have to know is when anytime you see some sort of high guaranteed rate, they're not talking about your actual cash. They're just talking about this income benefit, essentially just a phantom account that determines income in the future, and that's it. You can tell that, but if you look over here under the death benefit is going to equal exactly what your actual cash value is, not the income base. So for this person, 9.5% of $300,000 is $27,000. So you see that in the income credit column here. So for each year this person holds off or defers collecting income, they're getting $27,000 added on to their income base. So they defer 1 year, his base is up to $327. He defers another year, now the base is up to $354. Even though that his cash value is only $312,000. At that particular income base level, it's going to generate $17,523 per year for the rest of your life guaranteed. So even when your account comes to 0, they're still paying this money out every single year guaranteed. Now, how do they determine how much your annual income is? It's going to depend on this thing up here, this withdrawal rate. And this withdrawal rate is specifically tied to the age when you go to collect it. So the older you are, the higher your withdrawal rate will be. So in this example, this person started at age 62, they waited 2 years, now they're 64, they got 4.95%. So that's how they determined that 17,523. Now, one drawback with this type of policy is this particular one doesn't have an increasing death benefit. So you see the 17,500 stays flat every single year. So as inflation ticks up, or maybe we need more money in the future, this policy is not going to keep up with that. I do have policies that have built-in cost of living adjustments to them. Typically, they're going to either charge you more money for it, or they're going to give you a lower amount of annual income starting off with. So there's a couple of drawbacks using one of those. Another strategy that some people will use, they'll actually split their money up and buy a few different contracts and actually activate them every 3 or 5 years so they can increase their income on their own when they choose to. Now, it's no secret that because we're pulling out a 5% a year in this case, and we're paying a fee, in this case about 1% for that income benefit, that if our policy doesn't return at least 6% in this case, the value is going to go down over time. And you can see that's exactly what happens on the cash value. Is over time, there's going to be no money left in this policy. So your cash is going to be gone. So when you're entering into an income annuity, don't expect there to be any money left over at the end of it. Because again, the one goal we're going for is income. And this income is going to last for the rest of our life, guaranteed. So while you can try and make it in the market and have to take on that risk and hopefully it'll work out, it's nice to have a guaranteed income source coming into your bank account every single month. It basically turns your retirement account into your own form of social security or pension, where you can get a guaranteed check you can rely on and budget for accordingly. This also helps to reduce any kind of stress out there and worrying about the market and will I have enough money to last the rest of my retirement or not. This takes the burden off your shoulders. In fact, that's what annuities are designed to do, is to protect you from living too long and outliving your money. All right, so that's basically how it works. Now, one other important thing I want to touch on is how this cash surrender value works. So the cash surrender value is what you'd get if you were to surrender or terminate your contract and want your money back. And if you surrender it within the first so many years of the contract, they're going to assess a surrender penalty. In this particular case, this is a 10-year contract. And we can tell because that's when the surrender value equals the contract anniversary value. So after that 10-year period, you can draw any funds you want to, free and clear of any surrender charges. Now keep in mind, if you ever were to actually withdraw some of your cash from an income annuity and it's above and beyond what they're guaranteeing you in that particular year, that's going to affect your income benefit base and will actually lower your income payments in the future. So as an example, if you were to draw say $20,000 in this particular year and you're only allowed 17,500, the additional 2,500 or so would actually come off of your income base. In the future, your income base would be lower by about $2,500. Therefore, the next year's payment is going to be slightly lower. So something to keep in mind before you touch additional funds from these type of contracts. And also why it's important to have liquid funds available to offset any kind of unseen expenses so you're not forced to touch this type of policy. All right, so I hope that demonstration was helpful and now you have a better understanding of how that income annuity works and you can make an educated decision before going out and buying one. If you're looking to find the highest income available with an annuity, then I invite you to click below to apply to become one of my clients. And don't forget to subscribe to my channel. That's it for me. I'll see you guys on the next video. And remember, your future depends on what you do today.